Rent or buy. Home ownership is being your own landlord. You pay yourself rent, and as a landlord, you take care of the property and all the work and money that goes into maintaining it. When you're a tenant, you pay the rent and utilities and enjoy the benefits of having a landlord take care of the property. However, the freedom of home ownership responsibility might be more or less than you want to pay. Does this depend on where you're living? Yes, to a certain degree it does, and although we can measure various benefits and liabilities similarly, the unique nature of real estate markets has an impact. For this review, focus has been placed on three Canadian cities. Toronto, being the biggest and more expensive cities to live in Canada, Ottawa, which is the nation's capital city with a moderate housing market, and Edmonton, which is also a lower to moderate housing market influenced by the oil and gas industry of Western Canada's economy. Living in any one of these cities, a question that lingers is, do you buy or do you rent? Lifestyle is a factor in buying. The decision does involve a lot of financial considerations, yes, but owning a home is generally a long-term commitment that will affect your choices, habits, and career as much as your finances. How long are you going to live there? If you think you're going to move in less than 5 years, keep in mind that selling a house is costly. Paying for land transfer taxes, real estate agent commissions, and lawyers' fees, all those transactional costs generally can amount to between 1.5% and 4% of a property's purchase value. What are your long-term plans? To buy a house that will fit your needs for the foreseeable future is important. Are you planning a family or going to add some pets? If that's in your future, aim for a property that will be able to accommodate these things. Keep in mind that moving to a bigger place when you're renting is easy. Selling your home and buying a new one, not so much. How will owning a home affect your cash flow? A money issue, yeah, but it's also a lifestyle question. Can you afford to buy a house without becoming financially overstretched? House poor, that's called. We'll take a closer look, but renting a comparable property is generally cheaper, which means you'll have easier cash flow, more money to spend on other things. Once you've figured out whether you want to buy, you can start thinking about whether you can buy. Here's 2 financial rules of thumb. The first one, keeping the purchase price of the home to about 3 times your household income. The second rule of thumb is keeping your housing expenses, now that's including mortgage, property taxes, utilities, all within about 30% of your take-home pay. That's after you paid your taxes. Home insurance, maintenance, and repairs also add considerably to the ongoing expenses. Your home is a place to live, but a paid-off house is a valuable asset. Keep in mind, you'll need to sell it and find somewhere else to live in order to take advantage of that. Think of it as a mortgage being a forced savings vehicle. If you're disciplined enough, you can set aside and invest the money that you're saving by renting instead of owning. So, 2 sides of the decision to consider when it comes to rent versus buy question. Some argue that renting is a waste of money. You're not building equity in your home, and your housing costs will never go down. Others argue that since rent is usually cheaper than carrying costs of owning a comparable home, you can build wealth by investing what you're saving by not having to pay for those things like property taxes and home insurance. I think the truth lays somewhere in the middle. Renting isn't cheap. 40% of the 4.4 million Canadians who have a landlord rather than a mortgage spend over 30% of their pre-tax income. Generally, if a year's worth of rent adds up to less than 4% of the market value of a similar home, you're probably looking at a renter's market. If yearly rent works out to 5% or more, buying is more likely to be the better option financially. In most urban markets, It's hard to beat buying long term when your rent payment is higher than your mortgage payment for the same property. Crunching some numbers will provide some insight to renting or buying. Let's take a look at the three Canadian cities again: Toronto, Ottawa, and Edmonton. And let's just think about common elements, being a two-bedroom condominium apartment. Typically, this will appeal to first-time buyers and renters, as well as downsizing seniors and right-sizing single-parent families. Market appreciation is a wild card. Korea's home price index supports that over the past 15 years, and as of September 2019, the value of apartment condominiums has risen to a composite average to 242% nationally. The following table illustrates the market volatility over the 15-year time period. Let's take a close look at Toronto. It indicates a 274%. Ottawa indicates a return of 170%, and Edmonton indicating 163%. But depending on when an owner bought and sold, the return could have been significantly higher or lower than this aggregate average. This is an important consideration when deciding to buy or rent. But let's accept the values will continue to increase at least the Canadian Consumer Price Index rate, being about 2% annually. For the purposes of this analysis, and given that I don't have access to MLS data, I'm using the most recent CMHC, that's Canada Mortgage and Housing Corporation, published survey results that provide on average of both the monthly rents and market values of two-bedroom apartment condominiums. Like all averages, there are price points higher and lower. Specific neighborhoods have an impact on the market value and rents. So working with a realtor is the best way to tap into the details and help match your wants and needs to the right property. Using the average rent and market values and minimal market capital appreciation will provide a conservative result of our analysis. In comparison to alternative investments, we will use a conservative bond rate matching a 5-year term. This will level the field, as there are speculative investments that can generate higher gains, just like the market in real estate can have highs and lows. The financing is with a fixed 5-year mortgage and 20% down payment. Affordability and the mortgage rate stress test are two good reasons to get pre-qualified. The 5-year bond rate is at 1.49%, and the fixed rate 5-year mortgage is running around 2.71%. Okay. Two unique features with buying real estate is leverage and capital gains tax. Leverage means you can buy a $100 investment for $20. Borrow the 80. When that investment earns 5% return, it's worth $105. You have earned $5 on your $20 spent, which is really a 20% return. You can't do that with bonds, mutual funds, or the stock market, but you can do that with real estate. Capital gains is a tax the federal government charges on that $5 gain you made. Depending on your personal income and deductions, this can be as low as 15% or as high as 33%. So, on that $5 you gained, after you paid taxes, you get to take home $4.25. The great news is that your personal home is the only Canadian investment that is exempt from paying capital gains. Now, there's a new program offered by CMHC to assist with buying with less than 20% down. The catch is that CMHC will take a piece of the pie you've earned when you sell. This is essentially a form of tax that this Crown Corporation is marketing as a buyer's assistance program. Bottom line is, if you don't have the 20% down payment, keep saving. Okay, so we're using a 2-bedroom apartment condominium for our analysis, and as condos, one of the unique features is condo fees. Condo fees are a monthly expense that is paid by each unit owner to maintain common areas, and for apartment high-rise buildings, it's not uncommon to include heat and hydro. Most of the monthly charge is for routine services, including such things as lawn mowing, snow plowing, painting, repairs of common hallway areas, and whatnot, and a contribution to a reserve fund for future investments in elements of the property that are scheduled to be replaced in the future. Condo associations may also assess separate fees for unexpected expenses or to fund major property investments. Newer condos require less maintenance and may have lower fees, but these fees tend to go up as the units age. Oh boy. Given the variations in condo management models, a subjective and somewhat unsupported estimate will be used for this analysis. Let's take 10% of the property value. There's fees and costs associated with buying and selling real estate. Although the seller typically pays the real estate fees, a buyer is still responsible for paying for land transfer taxes, lawyers' fees, home inspection fees, and whatnot. There are also moving costs and many discretionary expenses that may include painting, decorating, minor repairs, or for larger expenses such as appliances. So, to summarize, you're staying in your home for 5 years. You've got 20% down, and you qualify for a mortgage at a fixed rate. You also have enough income to rent a similar home, and the landlord would pay the condo fees and property taxes. Either way, in both choices, you're going to pay for your own utilities. Of the three cities, Toronto is the most expensive to buy, and you'll need about $166,000 to cover the down payment and closing costs. Over the next 5 years, you'll pay out about $46,000 in expenses each year. Getting into the Ottawa condo market is less expensive, and you'll need just less than $59,000 for the down payment related closing costs. The ongoing ownership expenses are less than half of Toronto's, and you'll need about $19,000 a year. Edmonton is the least expensive city of the three. The down payment and closing costs are estimated to be just under $46,000, and the annual ownership expenses will run you about $15,000 a year. Okay, let's take a look 5 years into the future. The purchase price of your Toronto condo at $742,000 has increased to $819,000, and the mortgage you started out with at $593,000 has been paid down to $504,000. So far, so good. The equity is now $314,000 compared to the total down payment and purchase expense of $164,000. But to access the equity means to sell the real estate, which will cost real estate commissions and legal fees. That reduces the equity by over $45,000. The last downward adjustment is for all the ownership expenses paid over the 5 years. Well, since you had to live somewhere, let's adjust the annual expenses by the amount of rent that would have been paid. The ownership expense were still higher than the rent that you would have had to have paid, so at the end of the day, sadly, you're in a net loss position. Had you purchased in Ottawa, a 5-year look into the future is still not so bright. Similarly to Toronto, you could have rented and spent $76,000 less in annual expenses. The spread in equity growth between the net sale price, that's the sale price after commissions and legal fees, of $97,000 is more than the combined down payment and closing costs of about $59,000. Edmonton got you into the real estate ownership with the least amount invested. All things considered, you spent about $58,000 more than you would have had you rented each year. Those costs to sell the condo brings your net return of investment into the negative. The low bond rate is a safe and secure investment. Instead of using your cash for the down payment and purchase expenses, let's say it was deposited into a bond account for 5 years. Paying rent each month and no ownership costs freed up about $200,000 that you saved. Assuming no load and fees to sell the bonds, you can cash out with a positive net return of about 4% before taxes. Renting in Ottawa versus buying provides you with about the same investment return of 4%. And Edmonton does the same thing. Buying real estate is not a guarantee of financial success, and it comes with risks and challenges of ownership. It is not a short-term venture and is very susceptible to external influences beyond your control. There are also benefits to ownership as a vessel for building and holding equity for the longer term. Although you're paying for maintenance and upkeep, the money you invest builds on the investment, known as betterments, as well as just expenses that just keep the lights and heat on. As you pay the mortgage, you're reducing the principal amount owing, and at the end of 25 years, the house is mortgage free. Renting is also no guarantee of your financial success. Although your annual cash flow of expenses may be lower, it takes discipline to invest the money you're not spending on real estate ownership. Market appreciation is that wild card mentioned earlier. We've looked at the buy and rent decision through a very conservative lens when the realty in all three cities has experienced significant gains and losses over time. But the overall direction for real estate values continues to indicate an upward swing. Buy or rent, Toronto, Ottawa, Edmonton, it comes down to affordability, employment stability, lifestyle, and value for money. Saving is the first step to owning real estate and will establish the cash management principles that you will need to fund ownership expenses should you decide to buy. Pride of ownership and the benefits that are both financial and non-financial are legitimate reasons to buy real estate. Now, keep in mind this analysis reflects average rent and average sale prices of apartment condominiums. Typical and critical to your decision to rent or buy is the value for money, and if you can truly rent a comparable property when comparing it to its market value. Finally, as the numbers suggest, real estate is one of the biggest investments most people make in their lifetime. Always seek professional advice from those who know the ins and outs of the business: realtors, mortgage brokers, home inspectors, accountants, and lawyers. If you're considering buying real estate strictly as an investment, be prepared to hold it for longer than 5 years. There are options that can be explored if plans change unexpectedly and you have to move, but these will be the subject of another presentation. Here are some useful references that I have cited throughout this presentation. Please feel free to click on the hyperlinks and delve into more details that are offered at all these sites. Should you have any questions or comments, please feel free to give me a call or send me an email at the address provided. Thanks very much. I hope you've enjoyed this, and I look forward to our next presentation. Bye for now.